This video represents the completion of pages 18 through 26 on your Accounting 211 workbook. As you recall, we talked about the fact that in order to perform proper accounting, you're typically required to perform accrual basis accounting, which is the recording of a transaction not on the cash basis, but on the basis that an economic transaction has occurred. There is a way to convert accrual basis accounting back to cash basis, and we're going to go through a couple of simple examples of that. As a matter of fact, the first example will be converting sales and accounts receivable transactions back to their cash transactions, and we're also going to do that for expenses and payables transactions. But the first transactions we're going to consider are the accounts receivable and sales. So let's take a look at the relationships of accounts receivable, sales, and cash. Let's take a look at transaction A. We sold $100,000 of either a service or merchandise on account. We sold that on credit. Somebody's promising to pay us at a later date. So the journal entry to record that $100,000 would be a debit to accounts receivable, $100,000, and a credit to sales revenue for $100,000. Now, subsequent to transaction A, we entered transaction B, where somebody or a series of people paid us $70,000 on $70,000 on the amounts some of the amounts they owed us. So in this case, we're going to record this receipt as a debit to cash, receipt of cash, $70,000, and a credit to accounts receivable of $70,000 to reduce our claim on those people who had originally purchased from us on credit. So now we have two journal entries. What I want to do is show you when we post these journal entries to T accounts here at the bottom. So let's take a look at transaction A first. We have a debit to accounts receivable of $100,000, and we have a credit to sales, in effect sales revenue, for $100,000. Entry B, we have a debit to cash for $70,000 and a credit to accounts receivable of $70,000. Now, assuming these are the only two journal entries during the accounting period, at the end of the accounting period, we can now see the balances. The first we see is we have a balance in cash of $70,000. That represents a cash inflow because it's the debit to cash. We also have a balance in accounts receivable of $30,000, which represents the excess of debits over credits in accounts receivable. And we also have our balance of sales for $100,000. Now, there is a relationship, if you notice these journal entries in the posting to T accounts, there's a relationship to these two accounts, accounts receivable and sales, that result in a cash transaction. As a matter of fact, what I can do is to recompute my cash flow from simply accounts receivable and sales. I can take my total sales under an accrual basis of $100,000. I can then, in this case, subtract out my increase in accounts receivable. In other words, I started it out at zero and ended up at $30,000. So I take my sales, $100,000, subtract out my increase, and I end up with my result as I must have brought in or taken in $70,000 of cash. Now again, using debits and credits, that can be a little complicated. So I'm going to show you another way of doing it. And you can do it using the debits and credits I just showed you, but you can also do it utilizing in the next slide, the formula, which doesn't really read as debits and credits. Now, if we take a look at the top, we have two accounts, and that was from this represents our previous slide. We had accounts receivable, the beginning balance was zero and the ending balance was $30,000. Sales, our ending balance was $100,000, and we know from our computations on the previous slide, we know our answer, the cash flow. In other words, my cash inflow into cash of $70,000 created these two balances. Now I'm going to convert utilizing these two accrual-based balances into cash flow, and here's how I do it. I simply use this formula down here. I take my total sales for the accounting period, and I'm either going to add a change in accounts receivable or subtract a change in accounts receivable. As an example, if I take my total sales and I have an overall decrease in accounts receivable, I'm going to add that to my sales, and that'll be my cash received from customers. On the other hand, if I have an increase in sales, I'm going to take my total sales and I'm going to subtract out my increase in receivables, and I end up with the cash received from customers. So what you see right here is I have labeled my boxes: decrease in receivables on the top box, increase receivables on the bottom box. So if you keep this formula or this table consistent, you're not going to have any trouble doing a conversion. Now let's do this conversion as an example. Okay, the first thing I know is I have $100,000 in sales, so I'm going to enter that into the sales box. Now I need to measure whether I have a decrease or an increase in accounts receivable. And you'll notice I started out with 0 and I ended up with $30,000. So I've had an increase of $30,000 in accounts receivable. So I take my sales and I put the increase in accounts receivable of $30,000. So I take my $100,000 of sales minus my increase in accounts receivable of $30,000, and that means I received $70,000 of cash from customers. And if you take a look, that does agree to the $70,000 cash flow inflow on the previous slide. Okay, let's take a look at a slide that's slightly more complicated but using exactly the same formula. Again, I have my sales and I have my decrease on top and my increase on the bottom, my plus on the top and my minus on the bottom. So it's exactly the same formula. But in this case it says, given the following financial statements, or at least these are partial financial statements, how much cash was received from sales? Okay, my income statement says I had $150,000 worth of sales during the month or during the year of 2014. I also have what I call a comparative balance sheet. It's comparing accounts receivable, the ending balances of 2013 and 2014. And you'll notice obviously that the ending balance of 2013 automatically becomes my beginning balance for 2014. So I need my sales, so I take my $150,000 of sales for the year. And again, I'm going to compare my ending balance or my beginning balance of 2014 against my ending balance of 2014. And I see I've had a $40,000 increase. So I'm going to take that $40,000 increase and put it in the increase in receivables box. Now I simply do the math. $150,000 of sales minus a $40,000 increase in receivables means the cash that I received from customers during 2014 was $110,000. Okay, let's try this same formula one more time. This time it's going to be utilized in a little bit more complex story problem. Mocha Joe sells coffee beans to coffee shops. The company keeps its accounting records on an accrual basis. During the year, the company recorded $850,000 worth of credit sales. Receivables at the beginning of the year were $300,000 and $350,000 at the end of the current year. And the CEO of the company wants to know how much cash was received from sales during the year. So again, all we need to do is fit this information into the formula. So we start off with $850,000 worth of sales and I insert that. Now I have to determine whether I have a decrease or an increase in my receivables. If I take a look, my receivables started out at $300,000 and ended up at $350,000. So I've ended up with a $50,000 increase. So that $50,000 increase is going to go into the increase in receivables box. And there it is, $50,000. So $850,000 in sales minus an increase in receivables means that I received cash during the accounting period of $800,000. Now let's go ahead and take a look utilizing this a similar concept. Let's convert accrual-based expenses and payables to cash basis. Okay, again, we have two fairly simple transactions. And with A, we purchased $90,000 of expense items on credit. In other words, we purchased these items totaling $90,000 and we promised to pay for them in the future. So our entry would be debit expenses $90,000 and credit accounts payable, which means we have an obligation to pay in the future of $90,000. Later on during the accounting period subsequent to transaction A, we enter transaction B. We paid $50,000 of accounts payable. In other words, we took some of our cash and we paid down some of our accounts payable. So the entry would be $50,000 debit, because that's how much we're actually paying down accounts payable, and our credit to cash would be $50,000. Now let's go ahead and post those two transactions again. And in this case, we debit expenses for $90,000 and we credit payables for $90,000. Entry B then, we debit accounts payable $50,000 and we credit cash for $50,000. Now, obviously, this is a credit to cash, and in effect, since that would be, if we just look at this transaction, that would be a negative balance. So let's just assume right now that that $50,000 in credit just simply represents a cash outflow. So if we take a look at the accounts at the end of the month, we have the following. We have $50,000 worth of cash outflows. We have $40,000 balance of accounts payable, which represents the excess of credits over the debits in accounts payable, and we have $90,000 worth of expenses. And what you can see, if we take the $90,000 of expenses and subtract out our increase in accounts payable, that results in the difference between the two is our $50,000 outflow in cash. So with that, again, if you understand the debit and credit relationships, that's fine. If you don't, there's a formula for that. Let's go on to the next slide and take a look at it. Here's the formula down here. And again, it's total expenses, and it's plus or minus an increase, a decrease or an increase in accounts payable. So let's take a look at that decrease and an increase box. Okay, total expenses, if we have a decrease in accounts payable, we add that to our total expenses. If we have an increase in accounts payable, we subtract that from our total expenses. And whatever the adjustments are, that's going to be our cash paid through accounts payable. Now up at the top here, we see we have our accounts payable balance, where we had a zero beginning balance and an ending $40,000 balance. That's from our previous slide. And also from our previous slide, we have an ending balance of $90,000 in expenses. And you'll remember from the cash T account, our cash outflow in this case, I should say not just cash flow, but cash outflow was $50,000. So now all I have to do is utilize this information to calculate the cash paid through the outflow through accounts payable. So I take my expenses of $90,000, and now I look at my accounts payable account. I started out at zero. I ended up at $40,000. So in this case, I had an increase in accounts payable, and the increase was $40,000. So I'm going to insert that into my increase box. So my total expenses are $90,000. I'm going to subtract out my increase, which means the cash outflow through accounts payable was $50,000, which equals that amount that we had from the previous slide. Okay, now let's take a look at the next slide, which is again just a slightly more complicated version of applying the formula. And again, we have a comparative balance sheet and we have an income statement. And the comparative balance sheet has 2013 ending balance and 2014 ending balance for accounts payable. And remember, the 2013 ending balance becomes the beginning balance of 2014. So in this case, again, we have our formula boxes. We have a decrease and an increase. So we add the decrease or we subtract out the increase. So with that, we're going to measure our change in accounts payable. We went from $230,000 beginning balance at the beginning of 2014, and we end up with a $250,000 balance, which means we had a $20,000 increase in accounts payable. So now we take our total expenses of $300,000. I insert that in the box. And now I know I've had a $20,000 increase in accounts payable. So I insert the $20,000 in the increase box. So my total expenses minus my increase in accounts payable equals cash outflow through accounts payable of $280,000. Okay, one more slide, and this will be utilizing a story problem. Again, the trick of the story problem is trying to get extract the right amounts from the words. So Insignia Corporation keeps its records based upon generally accepted accounting principles, and that's a code word for saying accrual basis accounting. During the year, the company experienced a cash shortage. Management wanted to understand the amount of cash that was expended. In other words, how much cash did they actually flowed through accounts payable during the year. Now, the total expenses for the company were $300,000, and we know that all expense items were purchased on credit. In other words, all the expense items flowed through accounts payable. During the year, the beginning accounts payable balance was $550,000 and the ending balance was $400,000. So the question is, how much cash was expended through accounts payable, or how much cash outflowed through accounts payable? So again, we need to pick the right information. Okay, the first thing is we know total expenses were $300,000, so we place them in the total expense box. Now we have to determine whether there is a decrease or an increase in accounts payable. So what happens is we know the beginning of the year there was $550,000 balance in accounts payable. At the end of the year, there was a $400,000 balance, meaning that we had a $150,000 decrease in accounts payable. So we're going to apply that decrease to the decrease in accounts payable box. So we have total expenses of $300,000, and we add our decrease in accounts payable, which means the cash paid through accounts payable was $450,000. The next problem we're going to have is what I call the graduation problem, where we're going to combine the income or the concepts of cash inflows, cash outflows, and revenues and expenditures. So let's go ahead and go on to the final problem. Okay, this is the last exercise, and again, these are the type of exercises you could see in your exam. Okay, this company is called Firestruck Pottery, and they commenced their operations with $10,000 in their bank account. So their beginning bank balance was $10,000. Okay, they commenced operations, so there were no receivables or payables at the beginning of the year. Okay, Firestruck kept their financial records on an accrual basis. At the end of the current year, the company had $60,000 in sales and $45,000 in expenses. There were no other income statement items. In other words, there were no other revenues or no other expenses. At the end of the year, the company had $5,000 in accounts receivable and $10,000 in accounts payable. Okay, other than the company's cash balance, there were no other balance sheet items. So these are all the items that could have been in the financial statements of Firestruck Pottery. Now we're saying for the current year ended, what was the company's? And the first thing we want to look at is what was the company's net income? Okay, we have to remember net income is not cash flow. Net income is simply the recording of our economic transactions relative to sales and expenses. So we have to basically take a look at examine what we considered as to be the net income for the company. In this case, what we see is the company had $60,000 in sales. So that's our full accrued sales. So that would be the revenue for our period, and had $45,000 of expenses, and that would be fully accrued expenses. Now what we have to remember is, again, this has nothing necessarily to do with cash flow. These are simply a recording of the economic events on an accrual basis. So it's actually the calculation for the company's net income is very simple. Okay, we take the total revenue from our sales of $60,000. We take the total expenses of $45,000 and we subtract expenses from revenue, and we end up with a net profit, or net income if you will, of net income and net profit mean the same thing. So we end up with a net profit of $15,000, and that's the answer to A, by simply taking out the amount of accrual sales minus the amount of the accrued financial statement accrued expenses. Now let's take a look at B. B is actually not that complicated because we're simply going to use those same diagrams that we used before. We're going to pick out the information we need for net cash flow. Okay, the first thing is the company had $60,000 in sales, and we entered that into the diagram box. Okay, then we know the company had $5,000 as an ending balance receivables. Since the company had a zero balance of receivables to start off with, that means it had to be an increase of $5,000 in receivables. So again, we do the math. $60,000 of sales minus that $5,000 increase gives us and there we have, I obviously have a error right there. That should be $55,000 of cash received from customers, not $45,000. That should be $55,000. So please let's just remember that at this point. Okay, so those are my cash inflows from sales, cash received from customers. Now I want to take a look at my cash outflows, and I'm going to do that again by looking at my related expense accounts and my accounts payable account. So I'm going to use that diagram that I provided from the previous slide. In this particular case, what I'm going to see is I have $45,000 worth of expenses, so I insert those expenses in the related expense account in that diagram. Okay, now I want to determine whether I've had an increase or decrease in accounts payable. And of course, since I started with the zero balance, the $10,000 ending balance is an increase. So I put that into the increase box in my related liability account, which is accounts payable. So I'm going to be subtracting from the $45,000 of expenses. I'm going to be subtracting basically $10,000, so the cash paid for accounts payable was actually $35,000. Now again, please keep in mind that the cash received from customers should be $55,000. The cash paid for accounts payable is okay at $35,000. Now what I said is I need to compute my net cash flow, and it's a very simple thing. I compare my cash inflows against my cash outflows. My net cash flow is, okay, I have $55,000 of cash received, and again I carry that error onto this net cash flow statement. So that should say net cash received $55,000. From that, then I subtract my cash outflows. In this case, it's $35,000. That's the less that that's the cash that I paid at $35,000. So my net cash flow for the year should be equal to $20,000. And again, the reason it's not the $10,000 is because I had the $10,000 error on the cash received. So my net cash flow is $20,000. So that's very simply how I compute net cash flow from this. Okay, let's take a look at how do I compute the ending cash balance. And again, I'm going to have to tell you that I'm going to have to carry through that cash flow error because my net cash flow that I computed should have been $20,000. So let's see how I do that. Okay, I'm going to compute my ending cash balance. And what I do is I start off with the amount of cash received. That should have been $55,000. Less cash paid, and again, this is the exact information from the previous slide, $35,000. My net cash inflow should be $20,000. Okay, then all I would have to do is add my beginning cash balance, and that's told me right up here. We commenced operations with a cash balance of $10,000. So I add my beginning cash balance to my net cash inflow, and I end up with an ending cash balance, not of $20,000, but it would be $30,000. And that's how we solve this particular problem. And that's it with our presentation.